Today, we're joined by a true insurance industry thought leader, Bryan Falchuk. Bryan is the president and CEO of PIRB. He's a seasoned insurance executive, a keynote speaker, a podcast host, and the best-selling author behind the Future of Insurance book series. His books, including The Incumbents, The Startups, The Collaborators, and Asia Rising, uncover how insurers are navigating disruption, evolving business models, and responding to new customer demands. Bryan has a deep understanding of both traditional insurers and insurtechs and has dedicated his career to helping companies embrace transformation, move beyond outdated mindsets, and build a more resilient, customer-focused future. I recently saw Bryan give a keynote at InsurTech Live 25 and knew I had to have him on the show. Welcome, Bryan. We might get straight into it and dive into your perspectives on what you believe are the key ingredients or the secrets to innovation within complex organizations, particularly with a focus on insurance.
Yeah. I feel like people want a really technical and well-structured answer. And I'm going to disappoint pretty consistently on that, because I think it's like those are all fine, but that's second order. First order for me is really fundamental, and it's culture and the people and the way that you behave and the way that, when I say you, I mean from a leadership standpoint, all the way down to the line staff, but starting with leadership. Have you built a culture that is truly open and accepting, or are you actually filled with a bit of hubris and ego and at the same time sort of stuck in the, regulation and budgets and system constraints and all the things that are very real, but frame up a sense of impossibility. And when that's your starting point, that our people will placate them and have, idea competitions and give them a gift card and let them present to the leadership team, pat them on the back, and then never talk about it again. And the way we do it is right, or we've never done it that way, or we can't because of all these things. What do you expect to happen next? So, and this is where people get frustrated, is before you go on to any of the, innovation works best when it's done this way, or here are some great ways to bring it into the organization, you really have to start far more fundamental. And that's not an innovation question. That's just a general corporate culture ethos. How do you as an organization live? And if you get that right, you awaken something that is unbelievably capable. And that's where I focus. So I think it's more like a self-help question, actually, than it is, a corporate innovation structure question. It's not a helpful answer for what you're looking for, maybe.
Do you know what? It's interesting. I've been thinking about this particular theme a lot lately. It does feel like an underlying theme that comes across with a lot of leaders that I engage with. And I guess if we go a little deeper on that, how do you... That sounds like a momentous change for a lot of organizations, and how quickly, how rapidly, and how effectively can you create that right culture, right? Because you can't just change that overnight.
Yeah. So you can't, but with that attitude, you definitely won't. And so I think it's recognizing there's a place where we are, and there's some sense of better. And the reality is there is no end state to that. You're never done, right? So giving up on that, we can never get there, is every incremental improvement you make will pay dividends. I've been really lucky through my work to get kind of under the surface of a lot of organizations who have made these shifts. And look, I run a sub 50 person company that was very mired in history and structure and the way it was, and very command and control from the top. And I've had to do this in my org, but we're 50 people, not even. So I appreciate it's a lot easier to do that with a small org than it is if we were 50,000. But I've also seen it with companies that are over 100 years old, that have tens of thousands of employees. And my favorite example of them is a state-run insurance company in California, the State Compensation Insurance Fund of California, which when I say the name, immediately people recognize oh, this is not a dynamic monitor. No, it's it's an entity of the state, which means when you say you have politics, they do too. They have corporate politics, but they have actual politics. They report to the governor. Governors in California have been recalled. They change. There's all this political turmoil there, as there is kind of in any government, right? So they're subject to actual true politics on top of the corporate. Their staff are unionized. I mean, think about that. I was a chief claims officer. The idea that claims attorneys are union members is like mind-boggling to me, let alone all the other staff. And they're not just unionized, they're also civil servants. So they're employees of the state. And quite often that means lifetime employment is an expectation, even if it's not explicitly, a given. So that breeds a very different tone and culture in a 100-plus-year-old organization that effectively has no sense of, does failure matter because the state will bail us out. You can just imagine all of the layers of kind of traditionalism in that, and they've transformed. Now, I'm not saying they're done, and I'm not saying they're perfect, but they are not even just miles, like, light years past where they were. And it really started from this very powerful ground up energy in training, in messaging, and engaging their staff. They did design thinking training with literally everyone from, the cafeteria workers to the executive assistants, to the underwriters, to the IT team. Everyone was trained on it. We did that with my organization as well. They ran, once they did the training, these multifunctional groups where you got together with people from across the org and you worked on new ideas and you presented them to the C-suite. Lots of companies do that and they do nothing with it. As I said, when I wrote about this story in my first book in the Future of Insurance series, there have been 30 proposals put forth to leadership. 18 of them were either already done or being implemented. That's an amazing hit rate for any innovation activity whatsoever. And the ones that weren't, the 12 weren't just sort of swept under the carpet, or those people aren't here anymore and we just don't talk about them. They don't exist. We don't mention the failures. They weren't failures. They were learning moments, and a lot of them were, okay, what you proposed, great idea, not quite where your sense of where the market is. Like, this has shifted. Can you go back and relook at this? Or, yeah, that makes sense, but in 6 months this other thing will be happening, the system release, so that's not going to be relevant anymore, and we don't want to invest $2 million in something that's going to go away, a week after it launches, but brilliant idea. So there's that feedback and understanding, and the staff goes on and does another one. Like, that is a ground, and there were a lot of other things they did too to move the organization, but that's a ground up shift in an organization that I think all of the excuses anyone else wants to make, they get to make too, but then you layer on the true politics and the union. I mean, unions, you want to put in AI or efficiency or productivity, you need the union to approve that. And that probably means less employment, and people have to learn new skills, and it puts them at risk. Like, unions generally don't have, and I'm not bashing them, they don't generally have a track record of embracing things that might reduce employment. That's sort of the opposite of what they stand for. So I think to be able to move like that in that context is brilliant. So if you tell me it's impossible, I've got an example that I think puts that to rest pretty easily, and there's loads of others out there as well.
It's a great example. I'm curious, and you've talked about it being a ground up kind of swell. Were you able to identify the key catalyst for that? Because I think there's ground up, but you obviously need some support from the top, or you need a trigger from the top to go, no, this is the organization we're going to be.
Yeah. And in two of the organizations that I really profile with some depth, like, what did they do to transform? The other one's a small mutual insurer, regional player, sort of $250 million. The state comp fund is multiple billions of dollars, but monoline, monostate. So this other one, 20-ish years old, 125, I think at this point, and kind of small, sleepy, whatever. In both cases, it was a new CEO who came in. They're honestly two of my favorite executives in any industry ever. They're just great people that have really infectious energy, but are incredibly down to earth and genuine. And they came up through the ranks, not at those companies, but, working across different carriers, learning the trade, doing the work firsthand. So their understanding and appreciation was pretty deep. But it was new leadership. And I think you can do it with existing leadership. It's the hubris to me becomes the biggest blocker. And that's not usually something people wake up one day and are that self-reflective to say, you know what? I have been incredibly full of hubris. My sense of how great we are is not reality. And I need to get a lot more honest and bring that to the people. It's possible. Absolutely. People can change. I just tend not to see that happen. So it's usually catalyzed by some change in leadership, and often with a lot of board support, because they recognize, looked at, and that's same in my story, at my organization. The board was like, things need to change for the long-term viability and thriving of this organization, and us to be able to serve our members or our customers or clients or partners, what have you, the way that we really need to. So that's the kind of the first domino, if you will.
Yeah, I was going to say that puts a huge onus on boards, right? If they do want to change, then they need to drive that change and be really deliberate with the type of personal people they put at the top of the organization.
My board asked me in our first board meeting when I had joined as CEO, apparent, or like heir apparent, whatever, with like a 6-week overlap with my predecessor when he was retiring. And then my first board meeting, just me, they're like, what do you need for us to really support you in achieving all this? And they weren't expecting my answer, which was, I need to know you'll fire me. Like, I don't think you understood the question. It's like, no, I need to know that what I do matters. And if I'm not moving this organization towards where it needs to go, or I'm doing it in a way that is too chaotic or destructive or dangerous and out of sync with what you think our long-term vision is, which I believe we're all in agreement, I need to know that there are consequences and you won't stand for it. So for a board to just sort of, be there to placate or to be placated, that's the wrong answer. I've walked away from a couple of job opportunities at the CEO level where, to me, the board talked about what they wanted, and then you get into the interviews with them and you're like, they're not actually fully bought in and ready to do this. In all fairness, they could be in organizations that aren't either. So their sense of change compared to what they're coming from isn't necessarily what's necessary there. So yeah, the board's got to be 100% on board and willing to push.
And is that, I mean, have you seen in the examples that you've not only witnessed, you've worked with, but been a part of in driving that change, have you seen, is there a theme around a burning platform for change? Like what is what's driving that desire? Are their backs to the wall? Like, is it just a representation of the people on the board and their kind of attitudes and the way that they operate?
When I said it's like self-help, I think it's just like with people individually, is sometimes you need that moment where the risk is of losing everything is so great that you change. Wouldn't it be great if we didn't need that? If you didn't bring the organization to the brink. And that's where there are companies and organizations that actually thrive and do so consistently because they're not willing to accept it. So they recognize, how do we continue to push ourselves forward? And that's, Apple, I think, is an example of that. It's not that they never have failures, they absolutely do, but they generally don't really care about the competition, which can be dangerous, but it's because the competition is just that you're all sort of going head to head with each other, which is what we do in the insurance industry, right? It's a lot of FOMO. It's a lot of, oh no, they're all doing that, so now we have to. It's very rare that someone is willing to stick their neck out. Understandably, there's a lot of risk to it getting it wrong. But when someone's willing to do that and not necessarily let what exists in the market define their path forward, that's where you see, the outsized performance and the ones who pull ahead. I think Apple's been willing to do that on a number of occasions, versus you look at, the Motorola example is a famous one where they had all the patents and could see what Nokia was doing with digital phones and were making money off it, but we're still not willing to give up the cash cow, milking the cash cow that their analog phones were. Ironically, the same thing happened to Nokia years later with all their patents on Symbian that were being used for competing smartphone platforms. And they, made the same decision that they were very happy to be perfect and just reap the rewards and not risk, investing in anything that may play out at the expense of this highly profitable past investment that they were sort of just sitting on. And that didn't work out too well for them either. So just because you're the one who did it to someone, again, hubris, don't think it can't be done to you. And that I find stories like that really fascinating. BlackBerry's another one that, again, just completely did it to themselves. It's super rare, but it's not impossible. It is a choice.
Yeah, I think there's some great examples in history of companies doing well off the back of this. They call them bags, big, hairy, audacious goals. Just like, and it comes from that kind of ambition to go. That kind of attitude that drives that culture through the organization is, we cannot be complacent. We cannot be complacent. We are the leader. Let's act like a leader. and not act like a follower. And I think it's a risk that a lot of organizations, particularly when they get to a certain size and scale, is that their risk tolerance, right, becomes it changes. So they become less likely to seek the rewards that come with that risk. And there's a great example of Boeing, I think, in history. They almost, I mean, maybe to the extreme, but they almost went completely broke on this big, hairy, audacious goal of creating this this jet plane. And they basically went all in, all chips on the table. Turns out it paid off, but it was only through that kind of ambition of going, we don't just want to, we're not looking for system growth here. We're looking to actually change the conversation, change the needle, and sort of progress the industry forward.
Yeah. There are examples in insurance of this happening too. And I think about historic AIG and how it grew the way that it did. And look, AIG is not a perfect company. There's lots of other areas in the company where they've struggled or they've had culture issues or whatever. And the AIG of today is not the AIG of 20 years ago or 20 years before that. But one of the ways that they grew so aggressively over the years and successfully was their Asian expansion. So recognizing the US is hard to push into and will take too much capital, but Asia's open. And so their AIA business and the other expansions they made in Asia paid off fantastically, which then funded what they really needed to be able to succeed in the US and the more established markets. And that played out really, really well. The others, even within Asia, they were very willing to go into a market that didn't exist or push into something that was really nascent where they could set the right prices, take advantage of the fact that there wasn't competition, there wasn't a sense of what's expensive or cheap, reap the rewards from that. And then when they saw that the market was getting saturated, they had no qualms with pulling out. That's a different philosophy than a lot of carriers will want to follow, but it's at least an idea to consider that, look, you can do this in insurance too. Maybe you do it differently, but there are lessons out there we can take to say, could you not find a market segment or space, geography, products that don't exist, et cetera, where there's opportunity for you? It will be different. And it might be minuscule versus your business right now. If you're a $10 billion company, going after a $10 or $15 million opportunity is like, we can't stop for that. That's not going to show up for our shareholders. That's a waste of our capital. But if you say that to everything, then you're just sort of stuck with, well, we can buy someone. And that's kind of the only way we get to grow, or inflation, which is like neither of those is really growing.
Yeah. Yeah. Well, we see that time and time again, certainly in Australia, there are countless examples of.
You're not alone.
Yeah. It happens around the world, right?
Yeah.
We might shift a little bit. In a recent keynote that I saw you that I was incredibly impressed by, you pointed out that the traditional balance of risk, pricing, and cost structures in insurance may not necessarily be fit for purpose for the modern era. And I'm keen to sort of unpack that. And if you can tell us sort of why and where you believe insurers should be focusing to have the biggest impact.
So, historically we had the insurance cycle. And that meant there were years where it would be really unprofitable and you'd do your best to kind of stay afloat or stay consistent and just hold until profitability returns, but it would do. And you'd get that chance to make it back. It's like, I remember 2011, just a terrible year from a cat standpoint, in your market in particular, you had Christchurch, you had a lot of activity in various pockets of the world, but certainly ANZ got hit pretty hard.
Yeah, I think floods in Brisbane that year as well, if I recall.
Yeah, exactly. And like Argentina, and there was just a number of massive cat activity. And then things were quiet for, relatively speaking, for a few years after that. And so big hit to the industry that drove rates up, but then the losses weren't there to go with those rates. So before the rates came back down, you could make back that hole. That's not really the way the industry works anymore. And I had an executive at a dinner I was at 2 weeks ago was arguing with me that the cycle's still there. And I said, well, if you look at it, it really isn't. And it's been changing over time where the amplitude of the ups has been coming down, the amplitude of the downs, the soft market has been dropping. So it's getting worse in the downs and less good in the ups. And the duration has been shrinking for the upmarket cycles. So less chance to recover, more chance to lose out. If your strategy is just to wait until the hard market, you're running out of time and opportunities going forward. I think the opportunity is to look for how to succeed regardless of where the cycle is. And the problem with that traditional thinking is when it's tough, we will just raise rates and retrench, right? We'll shut off new business or we'll pull out of these very unprofitable lines, which I completely understand from a sort of stem the bleeding strategy. But the problem is when there's bleeding as widespread as we see right now, and these are macroeconomic and loss trend shifts that are not 2011. This is, 2023 was a terrible year in the US and many other markets. I live in the US, so front and center, like hail essentially destroyed the books for most carriers. Before there was ever a named storm, most insurers with property exposure in the US were already into reinsurance for weather-related losses, and we didn't have a single hurricane at that time, like by June, so halfway through the year. 2024, same story, really. Just even more widespread. There aren't, we could escape to this market or that. No, you can't, because there is weather happening everywhere, and there's massive inflation happening everywhere. And unfortunately, I think the U.S. is driving a lot of that these days with, the politics involved. But global trade wars do not help bring prices down, and those prices all impact us. Replacement costs, labor costs, settlements in court, all of it. These things are all going to be impacted. So you don't have a safe haven from a line of business, from a geography standpoint. And you're noticing this isn't a one-year blip. This isn't just like we had a lot of weather and it's gone. No, you look at weather losses, catastrophes are continuing to happen at a greater severity and less gap in between. And I just, last week in my podcast, I had a professor who studies resiliency, and this is specifically what he looked at over 100 years. The gap between major loss events has shrunk from years to months, and the amplitude of those losses has gone up just astronomically. So there's no safe haven anymore. If that was your strategy, just raise rates and retrench, you'll be left with nowhere to retrench to. So you will have been painted into a corner. And we're at a point where raising rates can help a bit, except you're raising them to the point that insureds can't afford it. So they can afford to buy at the rate we need to charge. And I've seen so much rate increase, yet still a lack of profitability. So you're raising rates, but the regulators generally won't let you quite get to where you need to be. So you're still unprofitable. So we can't afford to sell it and you can't afford to buy it. That's not a market clearing moment. And as you raise rates, quality risks will have opportunity to go elsewhere for a better rate. So they will leave your book. You'll be adversely selected. So when you put in a 40% rate increase, which that sort of thing is happening very much on a number of lines, with the book you're left with, that was the book you had. The book you're left with probably needed 45% or 50% or 60%. So you're still always behind the curve. So you never actually get correct rate for the risk exposure that you're taking on. So this strategy doesn't work anymore. And that's why I think we need to look at, if it's not working, does that mean not just, we're not rating accurately enough? We may not be doing, and there's new tools to help us get more accurate rate for every risk. But is it possible that the coverage doesn't reflect what the exposures are today? Because most modern insurance was designed sort of in the 1950s and 60s. Cyber's later than that. Some of the, the other policies certainly have been evolved since the mid 1900s, but the core kind of structure and mechanisms behind it largely unchanged for 50 to 75 years, depending on the line of business. I don't think anyone would sit here and say, yeah, construction has not changed at all in that time. Litigation hasn't changed. Medical delivery and costs and technology hasn't changed. And of course it has. So we've written policies and covers that really aren't connected to the modern exposures and the way those exposures are dealt with when they play out as a loss. That's what I think we need to focus on, is rethinking coverage, rethinking the tools we use to understand it and to price it. And then also the predict and prevent sort of war cry that's been talked about for years is a brilliant thing, but I haven't seen people make material impact at scale in that. There's pockets like honey, you and I have talked about, great example of trying to use IoT to stop some of the non-weather water losses as an example, which is the number one source of losses globally for non-weather in homeowners and some commercial property exposure. So why not use some simple IoT to do something about that, right? What are we doing at scale? We're not doing enough yet. So I think, it's risk selection, it's risk pricing, it's rethinking coverage and how we make it up, which may not always be an indemnity cover. Could be parametric or something else, and maybe it's a mix of things to better fit the modern exposure. And then actually doing something on predict and prevent. So making the risks we do take on better risks in the first place.
So who's best placed to take this evolved view of insurers? Is it the incumbents? Is it new to market? Are we talking about companies that already have an advantage with data, or like who do you believe is best placed to
so I think the answer is
regime?
I don't think that there's a single answer to that. So I think some of the startups can bring in some brilliant ideas, but the reality is they have a lot of advantages, but they don't have the scale. They don't have a lot of the resources and capabilities and, built up service delivery and vendor networks and all these other things that an incumbent has. So if an incumbent can take on some of the ideas that we see coming out of the insurtechs, this goes back to the innovation question. Yeah. What if an incumbent with all of the benefits and resources it has at its disposal is able to be nimble and responsive and sort of thinking about where the market actually is going? That's brilliant. I think there's a lot of very interesting things happening in the insurtech space. A lot of them need help. So they need capacity, or they need service delivery, or any number of other things. Collaboration is a brilliant way to get us there. So again, it comes down to hubris, right? So are you willing to work with someone new and different and not just back them up, but maybe take in some learnings about, it's interesting how they're thinking about this and the way they're able to move quickly. What if we did that? I sat in a sales meeting with a company that I advised several years ago, with a very large, very old, really successful US P&C carrier. And it was to do a pilot on a new AI tool to look at risk a bit differently and people's propensities to just behave in different ways and what that means for the exposure. And it was a brilliant meeting. Everyone's very excited. And at the end, it was, we want to move forward on the pilot. So great, let's draw up contracts. The head of the business pulled the startup founder aside and he's like, just so you know, it's still going to be 18 months before we're live because that's just how we work. And that was his whole justification for it. That's just how we work. And it's that moment, right? Like that's where you need to not accept it. And I think everyone learned in COVID, you can't, right? It's like suddenly enabling remote work and all these digital tools for service delivery. Let's take some of those lessons I think we learned that we are much more capable of moving very quickly and being forward thinking and flexible because we had to be. You can't just not handle claims because it's tough. You had to come up regulatorily. You must have come up with a solution, and we did. It was a lot of backbreaking labor and long nights and broken rules to do it. So maybe don't do it quite that way, but I think we could actually turn things around much faster if we gave ourselves credit for that.
Yeah. I love that it's just it's coming back just really, really strong as those kind of foundations of culture and leadership, just the importance of leadership. It may not be the organization that is best placed to succeed or thrive in the future of insurance. It may not be as a reflection of who they are, but actually what the culture's like and who's leading that organization.
Yeah. I think you have to be in a nice way, but a bit ruthless in not allowing that to fester. And that's a bit of human nature in politics, is that even if, there's an effort to move the culture, there will be pockets of people who are trying to protect the power that they have. And they see that change as a threat to them because they haven't sort of gotten religion on it yet. And so I think you do have to not allow for that or tolerate it and really root it out. And that doesn't mean go around firing everyone, because that will have the inverse reaction in the culture. But it does mean when there's a pocket of resistance, figure it out and figure out how to engage with that. And it may mean that the person is not fit for where the company's going, or it may mean that you need to go about it a different way with them, because if you can get that person on board, imagine the impact that has on moving other minds that are stuck. So, I like stories where you make change with the existing team, because it's quite powerful, and there's nothing like just seeing people kind of come alive. I know any teacher or person who's had teaching or coaching experience, like when the student gets it on their own in that moment, it's really rewarding, and it's incredibly impactful.
Yeah. So maybe, I mean, you have the advantage of, through your career, you've worked with a lot of different organizations. You've spoken to a lot of leaders. You've researched a lot of organizations, particularly for your book series. I wonder if there's any examples you have. You shared a great example in the California state-based fund earlier. If there are any examples that you've seen that have got you genuinely excited about, these guys are ready. They are leading. They are actually genuinely creating breakthroughs to sort of pave the way for the industry or the future of insurance.
Yeah. For my second book was all startups, and it was their complete journey. And that's where I think there's some really interesting new ways of thinking about things that were there. Interestingly, one of the stories that stands out was both a startup and the state comp fund did something very similar, where you look at the application forms that we ask people to fill out, whether it's personal or commercial lines or anything. They're onerous, and they're not just annoying and long and hard to fill out. We don't necessarily understand the questions we're being asked, or our sense of the data may be wrong. You ask someone the square footage of their house. I have a bit of dyslexia, so I have reported my house as like 500 square feet bigger than it actually is, because I flipped the second and third digits. And that's better than doing it the other way, because I've just, made that premium higher. And it's not like they'd suddenly pay out more if they actually came and adjusted the claim, but shame on me. But yeah, people don't necessarily know. So it wasn't anything malicious. I just screwed up. I went off memory, or, looked at a document and it was wrong. And that's actually publicly filed, right? Like, so my town has that data in the deeds and the maps and everything. Like, there's no reason you should be asking someone that is all available through public data. So just get the public data. So the state comp fund, to go back to them, had something like 120 questions in their small business direct sold workers' compensation application, which means the business owner's filling them out. The fewest questions was like 88, and then there's supplemental questions, so it gets up to about 120. Can you imagine you're a plumber or painter, or, whatever, carpenter? It's late at night, you've worked a long day, you've put the kids to bed, you're exhausted, and now you're trying to make sense of all these questions, and it's asking you to upload forms and all this other stuff, and you don't have any of that. Yeah. So the underwriting leadership locked themselves away in a room for days, had a facilitator to hack the app apart, and they got it down to, I forget the number, some like 65 questions or something, and they could not have been happier with themselves. And the rest of the leadership team looked at it and they were like, do you not understand? Like, I call it bank robbery question. It's like, last year I robbed 10 banks. This year I only robbed 8. Like, hooray for me. It's like, that's really great. I appreciate the progress, but you're not supposed to rob banks. The answer was you start at 0 and only ask what absolutely must be necessary. And that's on the startup side. It's a company called Branch. Homeowners, online quotes for homeowners was extremely rare. There was only one company that had done it, and it was that effort was led by the guy who ended up founding Branch. There were 300 questions in the largest insurer in the US in their application for homeowners. 300 questions. And there's an agent to help you with that, but that doesn't make it okay, right? That's terrible for the agent. So you can imagine how many of those were being skipped that shouldn't have been, or answered wrong, or what have you. Fast forward to founding Branch, they have 3 questions. And off the 3 questions, they will quote auto, home, and umbrella. No one had done umbrella online at that point. And the questions are your name, your address, and I think either phone number or email address. So it's a piece of contact information, and that's it. And they get everything else. And it's not that they don't, they've just given up on getting data and they're just taking a flyer on it. No, they're still bringing in that data. And in fact, they're bringing more accurate data, because it's actual data and it's risk specific, and they know what they need in those moments, and that's what they get. And I've seen examples of a small business, commercial MGA called Coterie that does the same thing, founded by an actuary who's very in the workers' comp space, actually originally, very frustrated with the data quality and seeing how much data was publicly available and not using it. And so they've been bringing that in. That is starting to permeate into more traditional players. It's just not uncommon in US motor insurance to just put in your license number and your name, and it brings back all the information because it can. So why are you asking them? It's less accurate, it's annoying, and it's slower for you as well. So you're starting to see things like that hit, but it's building up from zero. It's not shaving.
Yeah, I like that. And there was I mean, you and I were lucky to see a keynote at InsurTech recently where and Stephen Banham talked about this concept of, he was using digitization, I guess, as the example, or technology, but it was saying the most effective sort of transformations over time have been not around using technology to replace the existing process. It's actually to reimagine. And I think it's a similar theme to what you've said here, is actually, instead of going, how do we get it from 120 questions to 60 questions, let's actually look at it the complete opposite way and go, well, best case is we don't ask a single question.
Yeah.
And let's build it up and reimagine that experience rather than kind of just picking away and refining what we've got.
Yeah. I was talking to a startup about their sense of their competition. And that is, for any investor out there, if you ask a founder, tell me about your competition, and they say, oh, we don't have any competition, which I've heard multiple times, that is immediately like, we're not giving you a dime. That company is destined to failure. That's hubris at its worst. But I always point out to them, okay, fine, you have no competition whatsoever. And maybe it's such a novel idea that maybe that's true. But I think you're looking at competition too semantically and specifically. Competition can be nothing. So the alternative to your solution is we don't do anything.
Yeah.
And that wasn't quite how Stephen meant it, but it was like, yes, you can just rebuild the existing thing. And the joke he had was, it was all these laptops encased in plastic with RPA, just sort of, going through macros, basically emulating what people had been doing. And look how much money we saved. It's the exact same thing. It's just laptops sitting around doing it themselves. The alternative may be, why are you doing that process at all? Why are we asking those questions? And so for a buyer of technology, it may be like, yeah, we don't need to do this at all. Or why would we spend this money? The alternative can be nothing. And that's, I don't think we think about that often enough. And sometimes that's the right answer.
Yeah. It got me thinking, actually, what you just said. It's a question when I'm working with clients, if they're looking at a new market or a new proposition, is you often go, well, what's, sort of, who are you considering the competitors? And exactly what you say, like, even a novel concept, I think generally there's a substitute expenditure, right? So that money is being spent in some way, shape or form on something else. And that might be on labor, it might be on opportunity cost, it might be on the money's been banked and put on the balance sheet, or whatever it might be. So you've got to think about it completely differently, that there's always a level of sort of cost or competition with what you're competing for, right? That's always the case.
Yeah, resources and attention is a resource as well, are fixed. So if we're spending it with you, inherently we're not spending it with anything else, no matter what. We're not buying coffee for our staff, and that's not competition. It is competition because resources are fixed. So you have to think about every other opportunity. I think McDonald's or someone looks at everything a customer might do with their dollar is competition. Yeah, and it's like, no, wouldn't it just be Burger King or something like that? No, I forget what Burger King's called in Australia. I was blown away in the airport. It's everything ultimately is competition. So even if there really is no one else doing what you're doing, fine. That also means no one's a customer of that sort of solution yet. So your biggest competition is we don't spend anything and we're still in business. So could it be that wrong?
Yeah, exactly right. All right, well, we might change up a gear slightly and talk about the future of insurance. And I know that's where you spend a lot of your headspace. You've got a podcast, you've got book series, you've got all sorts of sort of stuff going on. As a thought leader in this space, I'm keen to look at some horizons of the future and sort of get your perspective on, I don't know what horizon we pick. Maybe let's pick 50 years from now, or 20 years, 50, 100 years. I'll let you pick the horizon. But what does insurance look like? What does the world of insurance look like in that future, and who's driving that? What are the drivers of that? Is it geographies? Is it catastrophes? Is it disruption? What are the things that are kind of driving that future, and what does it look like?
So I've been really lucky to be a part of an effort looking at 2050 or it's 50 years from now. Forget one way or the other. And it's sort of like, it's so far out, it's a little bit irrelevant how far it is, but it's enough time that really substantial kind of macro shifts can happen. So there's a lot on changes in population and sort of what countries are, more of a focus than others, and behavioral patterns. So we've talked so much about mobility the past few years, and Elon Musk has been telling us like autonomous self-driving cars are coming, later this year. For I think it's like the past 9 years he's said that later this year is. So I think by the 50-year point, or even by 2050, a lot of these things actually will have materialized, or be, even if they're nascent, they'll be starting to show up, which makes it interesting, because then you start to see, like, does that change more about what our business actually is? I think by then you will have seen some of the shift I'm talking about in coverage. People are playing with that now. So I mentioned parametrics. So mixing an indemnity product that still works in some aspects of that core, property or motor or workers' comp or whatever it might be, cover. Are there components that are no longer fit for purpose and economically not viable for an insurer to sell in a traditional way, or for a customer to buy? You're not just trading dollar for dollar with parametric. Like, we have $1 million limit for an indemnity policy and $1 million limit parametric. What's the difference? Parametrics don't work the same way. And so you shouldn't frame it the same way. And their economics are different, both in the cost of delivering it, but in the payouts and the actuarial models behind it. So I think we could have created the sense of an insurance policy. Right now, it's an indemnity policy, or you have a parametric policy. And I don't know if throwing those terms around, if I should define them, or if people generally
maybe just if you could just flesh out parametric in particular.
Yeah. So parametric is parameterized. So parameters is the core word there. Insurance. So effectively, if some generally like publicly verifiable or objectively verifiable measure is met, then there's a payout made according to a schedule. So for example, the city I live in, the city of Boston here in the Northeast US, 2014-15 winter was epic. It was a record-setting winter. The city had really smartly bought a parametric insurance cover for their snow plowing costs, that if the sum total of snow that fell at our major airport, Logan Airport, breached 100 inches, then the policy would pay out X million dollars. And the reason being, the city could only budget for so much snowplow activity. And so if it was over that, there'd be a bankruptcy issue for the city. So they had this cover that would step in and pay out a fixed sum of money. And obviously they factored that into their budget. We have to buy this policy, so maybe we can't actually maybe they could have done 110 inches without paying for the policy. So with policy costs, 100 inches. And we had something like, I forget the total number, 140 inches or something. It worked out brilliantly for the city. But it wasn't like an adjuster comes out and looks at the snow plowing equipment and looks at the budgets and does a kind of forensic accounting. No, it's automatic. This threshold has been reached. And so a predetermined amount of money is just paid out. Right. That's parametric, right? Something happens, it meets a threshold, money is automatically paid. In a traditional insurance view, a lot of people say that's gambling. You haven't had a loss. How can you just make money? It's like you basically just bet on, was it going to snow a lot this winter? And that's not right, because they may have incurred you could have there's a company I advise that does parametric wind and hail cover. So if you're in this area where there's wind and hail, actually it's a bad example because they do send someone out to verify that you did get hit, but they also have a tornado cover. So if you're in the path of the tornado as defined by the National Weather Service here, you get a payout based on the strength of the tornado. It's measured on the EF scale, the enhanced Fujita scale. You may not have suffered any damage, but if it was an EF1 and you were in the polygons that were drawn, $1,500 pops into your account the next day, automatically. So there's traditional insurance would say that's not right. You shouldn't be able to make out ahead because you had an insurance policy. That's true with indemnity. This is not an indemnity product. That's like saying, this car only has two wheels. Well, yes, because it's not a car, it's a motorcycle. So you're evaluating it against criteria that's irrelevant. That's been kind of like mentally a tough exercise for some folks to wrap their brains around. And I understand it. You're not used to it, and it doesn't seem to fit with your sense of reality. I think 50 years out or 2050 or whatever, enough of that will have moved. And I've seen some of the early signs of that in some commercial policies, some personalized policies that's starting where people are thinking about, look, I can't afford the traditional approach. What does the notion of having cover mean to me? Does it mean making me whole, or does it mean I'm not financially ruined? And that's a different, that's a different thing that you're buying protection from. But maybe that's more viable to sell and to buy. And I think we will have sorted that out because we have to, because the current state can continue for buyers or sellers.
Yeah.
So I think that's sort of the biggest shift that I hope will have taken place by then, because otherwise I don't think insurance will be relevant. There's other capital out there. Someone will solve for it if we continue down this path of economically non-viable offerings.
Yeah. Is that a similar structure to how reinsurance works with a lot of carriers with insurers? Is you reach a threshold. I guess it's still it's still about actual loss, isn't it? So it is different.
It's not the same, but there's aspects of it that feel familiar. Actually, it's like, well, so we've said you're covering the first 100 million, and once the first 100 million is breached, then we step in. It doesn't mean we just dump $80 million into your surplus, or but so in that sense, it's not the same, and there is adjusting going on. I mean, running claims, I worked very closely with our reinsurers and kept them apprised of claims, and they had opinions on it. So there was a sort of adjusting, if you will, going on there too. So technically that is not a parametric policy, but it's an interesting point you make, because it just sort of feel that way. It's like, well, we can verify that you've now gone $2 billion on this line.
Yeah.
And that's what we agreed. Yeah. And it's contracted. And our response to that is also built into the contract, which is the idea of parametric as well. As if this trigger is hit, this is what happens.
Yeah.
Yeah. It's an interesting point.
Yeah. I remember, it's going back almost 10 years ago. I was working for a major carrier, and we were looking at sort of alternative insurance options, and probably some similar concepts to what you're talking about. They were on a very micro scale, but it was like, I'm going on holidays to the coast for 2 weeks to the beach, and it rains the whole time, right? So my beach holiday is kind of like, it sucks. Yeah. I end up having to go to the movies. I go bowling. I go to kids centers, play centers. I do all the indoor stuff, right? Because that's my holiday has changed. So but our underwriters completely lost their mind around that. They're like, well, there's no loss. There's no actual, this is a really different. And the other one was like, you order an Uber, and then the Uber driver cancels. So you're late for your thing or whatever that might be. And it's kind of like, it's not a loss in the sense that we always think about a loss, but that idea of like a trigger happens that an inch of rain fell over that week. Here's some money, and use that money to go and spend on things that you wouldn't have had to spend money on otherwise, or whatever it may be.
Yeah. I mean, it's a sort of experience cover. And that's the other thing that I think there's been a lot of talk about. That's sort of the notion with mobility coverage, I think, as well as recognizing it was motor cover or motorcycle or bike insurance or whatever. It was about that specific asset and all of the exposures around that asset. But if people aren't owning a car as much anymore, or 50 years out, mobility means something very different. It's a combination of all sorts of things. And then it is more about the